Visa Incorporated, stock ticker V, is one of my absolute favorite dividend investments, and that's not a very popular thing to say within the dividend community because this company has a starting dividend yield below 1%. So what is it about this company that I think makes them such a good dividend investment? And in this video, we're going to be diving into that just a little bit, but you can see the company is currently trading at $231 per share. Over the past year, it's up around 20%, and over the past month, up around 3%. Now, over the past 10 years, you can see really phenomenal returns compared to the market, up over 400%. But let's go ahead and start diving into the financials a little bit more. And if we look at the revenue in September of 2013, you can see the revenue was $13.38 billion. Jump forward more than a decade, and it has more than doubled, now sitting at $29.3 billion. And what's beautiful about this is a very low-cost business, so you can see the gross profit has followed along. It's almost 3x'd actually. The gross profit has really improved, and we're going to see they have phenomenal gross profit margins a little bit later in the video. Now, if we keep scrolling down, one of the things you'll see, obviously, net income has more than 4x'd as well, so phenomenal net income growth. But if we keep scrolling down just a little bit more, I want to point out the earnings per share. Really strong earnings per share growth as well over the past decade. If we come down here and look at this payout ratio, one of the things you'll notice is it's pretty consistently stayed around 20%. So when you have a payout ratio that's staying the same while the earnings per share is growing quite a bit, that can only mean one thing. So if we jump over to the dividend tab, you can see they have a phenomenal dividend growth rate, 5-year dividend growth rate of 17.55%. So that is extremely good dividend growth, and they have a 14-year track record of increasing their dividend payouts over time. So yes, low starting dividend yield, but phenomenal dividend growth. So to help you understand why that dividend growth is so important, let's look at that historical dividend yield on cost. So I'll scroll down, we'll bump it out to the max, and so you can see right here is where they're sitting at about right now, dividend yield around 0.77%. But let's say you invested into this company around 2009 when the financial crisis happened. You can see your dividend yield on cost would be anywhere from around 14% to 16.25%. So that means if you invested $1,000, you could be receiving around $160 in dividends every single year. That is an absolutely phenomenal return, and it shows you the power of dividend growth investing. But that was during the financial crisis. So let's say we want to look at what it was like in around 2010. You can still see at that point your dividend yield on cost is going to be anywhere from around 9% to 10%, and that's exactly what we're looking for when we invest into these dividend growth companies. Essentially, anytime I invest into a dividend growth company, I want them to grow their dividend enough to where my yield on cost is eventually going to be 10, 20, or even 30% years down the road. It's the same way Warren Buffett has achieved a dividend yield on cost with Coca-Cola of over 50%. So Visa, phenomenal job of growing their dividends, and their payout ratio hasn't grown any either, which means they are doing a great job of growing the overall business as a whole as well. Let's look at that dividend growth a little bit more. We can see 10-year dividend CAGR of 19.6%, 5-year 17.55%, and within the last 3 years, 14.47%. And again, all this data is pulled from Seeking Alpha, which you can get a huge discount on at my link in the description. But let's go ahead and jump over to my valuation spreadsheet, where we're going to try to find the intrinsic value of Visa, because although it is a great business, that doesn't necessarily mean it's trading at a good value. So we'll be looking at a few different valuation models like always. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in the stock ticker V and hit enter, and you can see all of this data is going to automatically load in. Obviously, like I just mentioned, low starting dividend yield, but also a low payout ratio and phenomenal long-term returns. If I zoom out and look at a 500-day change, a little bit choppy lately, but it has been trending upwards over the past few months. Analysts currently have a target price of around $267 per share. Institutional ownership extremely high, and then we have a beta pretty close to 1, so the volatility is going to be pretty close to that of the market. But let's go ahead and jump into our first valuation, which will be Graham's valuation. And you can see the formula Benjamin Graham lays out for us right here in order to calculate intrinsic value. So we need things like our earnings per share, we need our growth rate projection, and then we multiply all of that by 4.4 and divide by Y, which is the current yield on AAA corporate bonds. And at the time of that video, this is sitting at 4.38. Now we can see we still have a pretty high growth rate projection as well, and I'm staying in line with analyst projections as well. Now we need to plug in our earnings per share. So the earnings per share right now is sitting at 7.49, but if we actually look at Seeking Alpha again, we can see the forward earnings per share sitting at 8.58. I think that's a better number to go with in this scenario, so I'm going to go ahead and overwrite that and plug that in here. And you can see when I plug all of this in, we actually come to an intrinsic value of $189.62 per share. So this valuation comes out a little bit lower than its current trading price. And a big reason for that is the current yield on AAA corporate bonds, sitting pretty high right now at 4.38. If we jump over and look at Moody's, we can see it spiked up quite a bit over the past couple years. Typically, it's going to sit a little bit closer from 2 to 3.5. And if that were the case right now, let's say we pick the middle and plug in around 3.2, you can see that valuation model is going to jump up by a considerable amount. So in a better macro environment, obviously I think the valuation would be a little bit better, but with that current yield on AAA corporate bonds sitting at 4.38, definitely going to push that valuation down just a little bit. Now, typically with financial stocks, I like to look at historical price to tangible book value, but that's usually going to be better for bank stocks. So I didn't use it in this scenario. Let's go ahead and move over and look at our multiples valuation. And you can see the comparable companies I'm using. I'm taking companies like MasterCard, we're taking automatic data processing, and even PayPal. We're taking their stock price, dividing by the earnings per share to get the price to earnings multiple. We then take the average price to earnings multiple, multiply it by Visa's earnings per share, which again, we plugged in 8.58 for that number, and you can see we came to an intrinsic value of $264.64. Now, typically when I do this with financial stocks, I also like to analyze the return on assets for these companies, and you can see the ROA for Visa really phenomenal, almost at 20%. MasterCard also has a really good ROA, but these other two companies, even though they have pretty high price to earnings multiples, as you can see here, their ROA is not nearly as good as that of Visa. So I definitely think Visa should be trading at a little bit of a premium with that good of a ROA. Now, jumping over and looking at our last valuation model, the dividend discount model, essentially it's going to value a company based on how much they pay out in dividends and how much that dividend is increasing over time. So what I've done is I plugged in the historical dividend payouts for this company so we can see how much they pay out each year. And this allows us to see our year-over-year dividend growth increases of 20%, almost 7%, 17.19, and 20% even. So that's an average growth rate of almost 16% over the last few years. So moving forward, I'm projecting a dividend growth rate of 7.75, discount rate of 8.5, and that gives us a dividend discount model price per share of $258.60 per share. So when we jump over to our output tab, we can see the three valuation models we used in this scenario. We have Grams at 189, multiples at 264, and dividend discount model at 258. When we average those three together, we come to an intrinsic value of $237.62. Now, the current trading price for this company sitting at $231. So let's say we apply a 10% margin of safety. Our acceptable buy price for the company sitting at around $213.86, meaning it's not quite within our buy range. And remember, Graham's valuation is driving this down a little bit because of the macro environment. I think under normal circumstances, Graham's valuation would be a little bit higher. A couple things I do want to point out is I do put my money where my mouth is. Visa is a position in my personal dividend portfolio. I honestly wish it was a little bit larger, but you can see I've seen really good returns so far. I am up, let's see, around 24.15% on this position. So Visa has performed pretty well for me lately. I'd love to have the opportunity to add more to this company, but more than anything, the reason that I love this company, we jump back over to Seeking Alpha, click on profitability, and look at that gross profit margin for the trailing 12 months, sitting at almost 98%. That is absolutely ridiculous. Anytime you see a company with that high of a gross profit margin, you can rest easy at night knowing there's not many people that will be able to compete with this company other than people such as MasterCard. But there you go. There's a few of the reasons that I love Visa. I would love to see this company come down a little bit in its share price because I would love to add more to my portfolio. So there you go. With a 20% margin of safety, you can see acceptable buy price 190, 30% acceptable buy price of 166. But there you go. There's an analysis on Visa. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.